So we often tell people, hey, saving for retirement is very, very important, but how you save, what type of accounts you're using is more important. Well, taxes are everywhere in retirement. Unfortunately, many people don't give any consideration to taxes when they're planning for retirement and how those taxes will come into play. Unfortunately, the way the tax code is set up in retirement, taxes are set up to really tax you very heavily in retirement because of what's called the taxation domino effect. And what that means is when we start taking money out of certain types of retirement savings accounts, not only do you have to pay tax on that money, but it also can trigger taxes on other incomes as well, like your Social Security income, additional taxes on dividends and capital gains, and possibly additional fees on your Medicare Part B premium. It's a domino effect, taxation domino effect, so to speak. And so you really have to get an idea of how taxes work in retirement, become educated on the tax code so you can set up your retirement plan to minimize taxes or hopefully put you in a position of paying no taxes in retirement. There's several different types of retirement savings accounts available. Most people save in the traditional type of retirement savings accounts like a traditional 401k, 403b, or an IRA. Obviously, in those type of accounts, you get a tax deduction going in with the agreement that you're going to pay tax on that money when it comes out. Other types of accounts like Roth accounts, Roth 401ks, Roth 403bs, Roth IRAs, those are tax-free in retirement. You don't get a tax deduction going in, but when you pull the money out in retirement, that money is not taxed, and it also doesn't go into the Social Security provisional income formula, which could trigger taxes on your Social Security as well. Once you hit the age of 73, the required minimum distribution age, that forces you to start taking money out of a retirement savings account and paying tax on money at that time, even if you don't need the income or don't want to take the income. So essentially, it's Uncle Sam's plan of getting paid back for the tax deduction you took when you contributed money to those retirement savings accounts and got a tax deduction for that. So Uncle Sam wants paid back, and required minimum distributions are the way he does that if you haven't taken any withdrawals beforehand. So RMDs are taxable, and that, depending on the size of your accounts, that could trigger other taxes as well. Again, additional taxes on Social Security, additional Medicare Part B premiums, additional taxes on dividends and capital gains. So RMDs are a major thing. You have to plan for them. So one of the key tools out there to get more tax efficient in retirement and get your buckets balanced properly is what's called a Roth conversion. A Roth conversion allows anyone at any age for any amount of money move money from a pre-tax position over to a tax-free position. That's called a Roth conversion. When you do that is you got to pay taxes on that money. But you have to remember, taxes are owed on those money in those pre-tax retirement accounts anyway. So the goal is to pay the least amount of taxes on it. So Roth conversions give you the opportunity of taking money out of that pre-tax account, move it to a tax-free account, pay taxes at the lowest rate you're ever going to see, and then get that money in a position where it'll never be taxed again. So again, one of the biggest tools out there, or the best tools out there for getting more tax efficient is taking advantage of Roth conversions, but their strategy on how to do that the most proper way. So when it comes time to taking income from your different sources in retirement, being able to take some of that income from a tax-free position can extend your income in retirement because, again, it isn't taxed. So again, it avoids that taxation domino effect. So having your money set up properly in the different types of buckets, balanced properly, gives you the opportunity, or who you're working with, the opportunity to strategically draw money from those different sources to give you maximum income with minimal tax. And that can extend your retirement income for a lot longer in retirement. The traditional retirement savings account is the most popular tool in saving for retirement. We've all been programmed to save in those traditional types of accounts where you get a tax deduction going in and then you pay taxes when it comes out. And the idea behind that is you're going to be in a lower tax bracket when you retire. Unfortunately, though, many times you're not. And what happens is when you start drawing that money out in retirement, you find yourself in the same tax bracket or a higher tax bracket, which means you pay a lot more taxes than you should have. So case example, let's say you're saving money in a traditional retirement savings account. Say you're doing $10,000 a year out of your salary and you do that for 20 years. So at the end of 20 years, you have put in $200,000 into your retirement account. Now you got a tax deduction for that. So let's say you got a 22% tax bracket. So you basically save $44,000 in taxes while you were saving. Now it's retirement time. And let's say that $200,000 grew to $400,000. Well, now when you pull money out, you have to pay tax on the $400,000. Let's say you are in a lower tax bracket. Let's say you're down to 12% for some reason. Well, take 12% times 400,000. That's 48,000. So now you're even paying more taxes in retirement on those contributions than you saved. So you really have to plan things out to make sure you're saving the proper way in retirement, because again, you don't want to put yourself in a bad position later by saving the wrong way. So we often tell people, hey, saving for retirement is very, very important, but how you save, what type of accounts you're using is more important. When you really think about taxes in retirement, most people really don't understand how the tax code works in retirement and how to properly set up their accounts for maximum tax efficiency. I get it. It's definitely a complex puzzle, and you want to make sure you're working with the right retirement professionals who can help you get your retirement plan set up the most effective way to minimize your tax burden in retirement, or to hopefully put yourself in a position where you become tax-free in retirement. We've been very fortunate to help a lot of our clients transition their retirement plan to a completely tax-free position, and that's always a great thing when you can draw your money in retirement, set it up for lifetime income with no tax. That's the ultimate place to be. And most people can improve their tax efficiency by simply making some strategic adjustments in their buckets, get those buckets balanced properly in order to achieve maximum tax efficiency.